Venture capitalists are individuals who work somewhere on the border between the traditional world of financial services, the sphere of investments, and the world of sci-fi, as I like to call it. And that kind of brings us to today, where we have a record number of individuals who can invest in African markets. They're operating in a different world.
What we've seen in the VC space in Africa particularly is there's been a rise in the VC space, say the early 2019 and going to 2021, there was this peak of investment, and then there was a downfall, and VC referred to that period as a winter season. And then they were raising again for a long period of time after the investment was not going as fast as it was going in initially, because there wasn't enough capital around anyway, but also it seems like the investors themselves had learned something about the market.
Suddenly, Africa sounded not just like the consistently high risk, high reward opportunity, but a validated high risk, high return opportunity. And because of that validation, we saw a number of investors who'd been burned in Europe, burned in the US, burned in Asia, or frustrated by all of this pendulum swings, starting to actually say, you know what, I finally feel confident enough to invest in African markets.
Today's guest is Mark Kleyner, co-founder and co-CEO of Dream VC, an Africa-focused venture capital institute helping build the next generation of investors across African and emerging markets. Mark describes himself as a venture capitalist, educator, and fund builder, three roles that sit at the heart of this conversation. In this episode, we go behind the scenes of venture capital, where VC money comes from, how LPs and GPs shape investment mandates, why fund economics affect founder conversations, and what many entrepreneurs misunderstand about how investors make decisions. But Mark's work with Dream VC points to a bigger question. Africa does not only need more founders, it needs more capable investors, stronger fund managers, deeper local capital, and better capital infrastructure. For From Scarcity to Scale, this conversation matters because it looks at the other side of the startup equation, not only how African ventures are built, but how they are backed. Mark Kleyner, welcome to From Scarcity to Scale.
Mark, welcome to the show.
Thank you, Daniel. Thank you for having me.
No, it's such a pleasure. Mark, tell me, if you were to describe yourself in 3 words, what words would you use?
Oh, tough. Well, I'll say venture capitalist and educator. That's the 3.
That's 2 words. Okay, venture capitalist is kind of one. It's kind of one word.
Okay, let's say venture capitalist is 1, then educator is 2, and then fund builder is 3.
Gotcha. All right, let's start with venture capitalists. What is a venture capitalist?
It's a good question. So venture capitalists are individuals who work somewhere on the border between the traditional world of financial services, the sphere of investments, and the world of sci-fi, as I like to call it. I believe that venture capitalists have what, in my biased opinion, is the best possible role in the financial sector, because you are a financier. Your responsibilities are similar to many other people in raising money from external parties, taking that money and being a fiduciary, i.e. a legally responsible financial manager of that money to invest it somewhere. That part, I would say, is relatively standard with asset managers, private equity professionals, and others. The part that makes venture capitalists is who they invest in and how they invest. So venture capitalists in particular support the most crazy, most disruptive types of small businesses and startups that are trying to compete with the entire world. The businesses that try to defy conventional business logic, either coming up with an innovation in the way you actually consume a product or service, or an innovation in the way we interact with a product or service. So business model innovations, product innovations, technological innovations, companies ranging from the future Facebooks and Alphabets of the world to those that change hypothetically boring industries like the oil and gas sector, like the recycling industry, and move it forward. Many of these businesses, because they're trying to do something that has never been done before or never done in this particular context, in this particular application, cannot build a business like you would for a restaurant or a laundromat. You don't have a clear step A, step B, step C, how I build my business. So there's a lot of risk involved. And because there's a lot of risk involved and usually limited collateral, banks and traditional investors do not want to support such businesses. At that early stage, the business has a high rate of failure and they need funding to enable them to grow until they can get to a point of operating profitability, funding to support their research and development to come up with these crazy ideas, but also operational support. So they require some degree of handholding, some support on sales, on technical side, and more. That's where venture capitalists roam. So why a bit of the investment side? Because we invest in companies. Why a bit of the, let's say, broader financial services? Because even though we like to think that we are entrepreneurs, we still do have a financial obligation to someone who gives us money to manage. But there is a little bit of that sci-fi because unlike bankers and others, we get to dream directly alongside our investee and potentially feel like we're a big part of creating something completely new, whether it's a new service, new product, new idea, or potentially a new economy as a whole.
Interesting. That's a very thorough definition of what a VC is. Thank you for that. Then the follow-up question is, where do VC, venture capitalists, we're going to call them VC going forward now that we define them, where do VCs get their money from? Is it just some rich people that come together and start investing, or how does that work?
No, not entirely. It can be a group of rich people that come together and start investing, but that's actually a different type of investment. That is called a syndicate. Not like a criminal syndicate for anyone listening who's used to watching Hollywood movies, but just a group of individuals who pool money together. In fact, that model is actually a model that's been very common across African markets in particular. Investment clubs, savings cooperatives, and others essentially are just a group of people pooling their money together to make an investment into a project. Now, an investment syndicate is just the same, but for a group of high-earning, not yet wealthy, or high-earning and wealthy individuals who pool their money together to invest. Now, what is different about a venture capital firm is that a venture capital firm is a long-term entity. It's an entity that doesn't necessarily have a starting point and an ending point. It's a company that is registered with the explicit purpose of setting up underneath it multiple individual funds, where each fund then has a key purpose of what it will invest in, whose money it will invest, and how it will invest. There's obviously a lot more nuances about it, but that's the simplified level. And now the money that they invest comes from different sources, but this largely relates to where the fund wants to invest. For example, if the fund is investing alongside a clear strategic direction, for example, the fund is investing specifically in oil and gas technology companies or in companies that are trying to improve the supply chain of the oil and gas sector, most likely they're doing that not just because the fund manager believes that's a good strategy, but because some of the people who've given the fund manager money come from the oil and gas sector, which gives the fund manager an advantage when they invest in this sector. They can tap into the expertise of their limited partners. Limited partners are the ones who provide the money. And then the fund manager becomes the general partner who is involved day to day in managing the fund. Generally speaking, if we look on a global level, there are many different categories of entities and people that can be limited partners, and high net worth individuals is one such category. So anyone who is wealthy, who decides to put some of their savings, some of their wealth, and give it to a venture capital fund and say, manage that money on my behalf, put it into tech startups, that's one category. Beyond that, we have the category of family offices. Generally speaking, individuals whose net worth tends to exceed about $50 million or the same in other currencies tend to say, look, I don't want to just keep my money in a bank or have a wealth manager in the bank manage my money. I will create a separate mini investment fund that will manage my money because I have so much of it. So when you have 50 million, 150 million, 500 million, 5 billion, often you'll end up in this scenario creating a family office. Many of the families over time that are the famous ones we'll know and see around the world, whether it's the Rothschilds, the Oppenheimers, but also the families of, for example, very successful startup founders who've made money just by building a business and now sit on that money and don't know how to manage it themselves, set up a family office. Now, these family offices, their main purpose is manage the money of a family and ensure that you make more money than the family spends. So, as long as the family is spending a lot of money, you need to make a lot of money. Where do you make a lot of money? By investing in high risk, high reward opportunities. So family offices also often invest in VC funds. But beyond this comes the traditional layer of where most people think money comes from, and where in the US, in Japan, in Europe, in reality, most money comes from for venture capital funds. That is the government sector, government allocating through sovereign wealth funds and innovation programs. That is the banking sector, many banks themselves looking to diversify their total strategy for all of their assets under management by putting a little bit into high-risk strategies. That is pension funds, provident funds, and retirement funds who manage the employee earnings, savings, and pensions of groups of employees. For example, all the employees tied to a particular factory or all the employees working in a particular government facility, putting a little bit of that into startups or into funds. And finally, we have the corporate sector as well. Now, technically, if we really wanted to get specific, there are endowments, there are foundations, and all different types of institutional entities. But if you really had to break it down, we have the individuals and the entities that manage the high net worth individuals' money. We have the corporates and the entities that manage the corporates' money. And then we have government and the nonprofit sector, anybody who manages their money. So these are three broad categories, and these three broad categories all in some way trickle down into the venture capital space. The most common logic being that venture capitalists are the only ones crazy enough to spend time alongside the startup founders, crazy enough to actually travel wherever they need to travel, crazy enough to potentially work on sometimes a low day-to-day salary with the opportunity of a high long-term return. So they're the ones who are the, let's say, front line interacting with the founders, the startups, and innovation. So they end up being the barrier between the institutional world and the world of investing in startups.
No, thanks, Mark. That was very thorough. And so let's go to the beginning. In the case of, for instance, LPs, limited partners that gets to invest into, fund managers or give a VC firm some money to invest on their behalf. That's where mandate comes from, right? Or does it come from somewhere else? Because then you often hear founders will ask you like, okay, any founder just come to you and ask for some investment, and you tell them, well, there isn't a mandate fit here, so we can't give you money. So mandate, that's something that is dictated by the LPs, or is it something that VCs themselves decide, oh no, we're just only going to invest into this?
So it's a combination of both. A mandate doesn't come directly from the LP unless the LP creates their own fund. But it also doesn't come directly from the GP unless the GP manages their own money. It's always a bit of a principal-agent problem. In some sense, the source of money in most VC funds, by the majority, comes from the LPs. The international average is 95%. So anywhere from 95% up to 99% of the money in a VC fund doesn't actually come from the manager of the VC. And this is a common misconception. People look at a fund and they see, oh, you are managing $10 million. That means that you must be a millionaire. No, you are just an agent who is representing an entity that has been endowed with $10 million. Your individual salary might be $10,000, $50,000, $100,000, but certainly nowhere near the $10 million that is managed by the fund. Broadly speaking, you have to think about it a little bit like this. The limited partners might have a financial or a strategic reason to invest. Most of the time, it's financial. If you think about a sovereign wealth fund, what are they looking to do? They're looking to build the wealth of the nation. If they're looking at a pension fund, what are they looking to do? They want to increase the value of the assets under their management. And it's similar to endowment funds, to foundations, to funds set up in perpetuity, and many of these other entities. They essentially have primarily a financial goal. So if they have a financial goal, they will not tell somebody who's managing their money, this is exactly how you should manage my money. Because they are taking the intentional step to say, if I'm trusting an external manager who is an expert at investing to manage my money, I'm trusting them because they should know better than me where to invest this money. If I knew it, I would invest it directly, right? And you do see that some sovereign wealth funds like Temasek, for example, from Singapore, they have actually had more confidence over time in investing directly, and they do. They've invested in some of Africa's biggest investment firms. They've invested in some of the biggest deals as well, but they don't go early stage. When they want early stage, that's when they go to venture capitalists and give money to VCs. Now, the other side of the coin is that VCs in general are the most opinionated of the financial services sector. So I say this in a good way and a bad way. I'm sure all of us, those listening, those watching, those reading about the financial services, have interacted with some people who come across a little bit overconfident when they work in the financial services. Whether you're working in banking, you're working in some form of financial advisory or consultancy, I think a good ego tends to be a natural side effect of working in an industry where you're handling a lot of money and potentially affecting a lot of people's livelihoods in a good way or a bad. Now, how does that manifest in the venture capital sense? Well, venture capitalists exist in this part of financial services, which is often overlooked and sometimes intentionally avoided by the more traditional financiers. This is a space where there is much less regulation, there is much less reporting, and there's much less oversight, which means that a venture capital fund is not reporting to the government, to the tax authority, or to certain regulators on a regular basis. What exactly are they doing? That gives them a lot more leeway. And hence the idea that it's sometimes seen as a bit of a cowboy Wild West environment where you tend to do whatever you want to some extent and then find the consequences and face them a bit later. But what does that enable? That enables certainly a character of more confidence and more autonomy for the fund manager than for a fund manager of a big asset manager, for example, or of a public markets listed fund. Now, what does that look like from a mandate point of view? Well, from a mandate point of view, that means that the LP is saying you have some ability to set a mandate, but then the GP is the one that's saying, I want as much freedom as possible to set the mandate. So it ends up being a combination of the two. The GP is often quite headstrong, quite confident, quite influential often, just by nature of ending up in this quirky part of financial services, will be the ones who say, look, I strongly believe that this particular sector makes sense. Whether because of your research, your anecdotal experience, your discovery of startup opportunities, you strongly believe that a particular strategy, where to invest, how often to invest, the size of ticket, etc., that's their belief. And then the LP has their own beliefs, which, as I said, predominantly are financial. So how do the two meet? Well, sometimes the LP might say, look, I trust you, but not 100%. So some of these parts that the GP wants simply do not align with what the LP is comfortable with. And it's that compromise where the two overlap that is ideally the point when the LP says, okay, I agree, we can move ahead on these terms. Now, GPs would happily take the money with no terms attached, but that's not how it works. The way that VCs fundraise is they sign a very long document, a document that would scare anyone who is afraid of the legal contracts because of the depth, length, and potential ramifications. That's called a limited partnership agreement. And that's arguably one of the most important documents for any VC to be familiar with. It's a document no startup ever sees, but that document is ultimately the one that has the biggest impact on mandate. Because that document is the GP and the LP agreeing on where is the overlap in their interests and what do they agree on in terms of mandate. And how does that manifest in practice? That then becomes the investment thesis that the VC discloses to startups when they say, hey, you're not a thesis fit. So you see, for example, an edtech startup applying to a fund and the fund says they're a generalist, but then they say we couldn't invest in you because it wasn't a thesis fit. That might simply tell you that maybe behind the fund there are a number of banks who don't want to have the money going towards edtech. They want it going into fintech or maybe digital commerce or something to that end.
Terrific. That's actually, let's stay in this lane and talk a little bit more about these limited partnership agreements that the VCs have to sign. One on this, obviously, when the LPs give the GPs the money to manage on their behalf, it's not out of pure altruism. They're just not being generous. Of course, they want return on investment. So I want to understand, what's that life cycle like? Is it like after 5 years, after 10 years, we want to see return on our investment with this much percentage, etc., etc.? What are some of like what's the word? What are some of the terms that are enforced into these agreements that the VCs have to sign?
Yeah, it's a good question. So I think we need to think about it from a few points of view. One is the desired rate of return on the actual investments from the LP's point of view. That is the opportunity cost from the LP's point of view when they are investing in a VC fund rather than investing anywhere else. So any institutional LP has options. And that's the first thing that's important to understand. A little bit like a VC fund, when they are approached by a startup, and the startup sometimes feels outraged that the VC says we'll pass, even though the opportunity looks like a good one. Any VC at any point in time has options. It's a little bit different to the world of dating. When you're dating someone or you're in a relationship, you cannot just date a potential significant other and tell them, hey, I have options. You are maybe the top 5%, but I'm afraid you're not the top 1 of my funnel of 100 people. Maybe some people date like that. Most of us don't. Most of us are not quite that suave in our abilities. Now, for venture capitalists at any point in time, they're usually looking at a range of different companies and trying to see which ones among those companies have the highest statistical likelihood based on the venture capital's own theory, pattern matching, strategy, approach, anecdotal experience to potentially have an outsized return. The reason why the VC fund is doing that is that the VC fund's biggest area of compensation for themselves comes as a share of the return they will make to their limited partners after they first return 100%. That is a really important detail. The VC fund, in 9 times out of 10, unless of a very specific structure, will not make extra money and will have no share of the potential profits made by the VC fund as a whole until they at least return 100% of the money they took from limited partners. Which means for limited partners, even though they are risking a lot by putting the money into the VC's pocket, they know that the VC has every incentive to invest into higher return businesses because at the minimum, the VC only makes money when you make money. Now, after the initial 100% return is returned to the LP, then we start distributing profits. And in the venture capital space, we call these profits carry or carried interest, which essentially means our share of profits of the investments that we've made. The way that VC funds will make money, and this is actually mandated by that LPA as well, is that most of these limited partnership agreement documents will push the VC to say, do not just accept dividends. We do not want you to invest in companies that become slightly profit-making, take a little bit of dividends and feed that back up to us. Because LPs can do that themselves, investing in much bigger institutions. Instead, they say, we want to see capital gains. That's one of the things the LPAs will push for. And then they will say, invest in companies, get a substantial return in the total value of the asset appreciating over time, and sell it. And what is a substantial rate of return? Well, for reference, a good VC will almost always promise 25% annualized return in their investments. What does that mean in practice? Well, assume that 25% is compounded over 5 years, 7 years, 8 years, 9 years, 10 years of a VC fund's existence. That's pretty sizable. That's several 100% worth return on investment. If we're talking about a $10 million fund, that could mean promising your LPs you're going to give them $50 million after 10 years. If we're talking about a $100 million fund, $500 million. And this is where sometimes VCs and life sometimes clash. The VC economics assumes that the VC will hit a successful company enough times, have enough ownership in those companies, and have enough opportunities to actually sell that ownership and get the appreciation in price that the total returns will be so substantial. But all of that is then affected by the high failure rate in the startup space, which is where LPs then put in certain provisions. Hey, we want to have a limited partner advisory committee so that there is some degree of accountability. We want to have an opportunity to get involved if at any point one of the general partners of the fund leaves. We want to have a vote over what the fund does if the fund wants to change their whole investment thesis. Because a lot of these core factors would have affected the overall promise the fund is making to the LP. They're saying, I'm going to prioritize your money, I'm going to give you this return, I'm going to invest in this particular way. If you're starting to change any of these things, you're actually going against your LPA. So generally speaking, the IRR or the internal rate expectation for investing in VC funds tends to be north of 20% annualized, which if you actually think about it, is very hard to earn by investing in real estate or by simply keeping your money in the bank. By pushing that IRR, the LPA actually encourages the VC not to sit idle on their money, which is why you see a lot of VCs investing very quickly across 1 year, 2 years, 3 years, 4 years, or 5 years. Sometimes bigger asset managers say, why are VCs going so quickly with making their investments? Well, it's because they're actually penalized for sitting on that money. As soon as you accept the money from an LP, as soon as you do what VCs call a capital call, you call them up and you say, send the money to my bank account, I'm ready to invest. That's the point from which the LP is counting their returns. So you're keeping it in a bank. Maybe the bank's giving you 10% return. That's a negative 10% return per year relative to what you're supposed to offer. So then when you invest, now you need a 30% annualized or higher to actually get the results you want. And this often also then manifests in how VC funds end up treating founders. I've seen so many founders over the years who say, look, I have a 100% guarantee I'm going to get 2 times my money, and I'm going to definitely give you the money back. And the VC fund says, that doesn't work for me. And then founders say, VCs are crazy. They don't want to invest. Why would you not want a guarantee on 2 times your money? Well, that's just because with the economics that VCs work in, 2 times your money is actually not that attractive. They need 10 times your money, 20 times your money, 50 times your money to account for any startups that will not succeed. So there are many different other terms that will feed into the fund economics, like a desired minimal return above that 100% that the VC has to return. That's called a hurdle rate, for example, that the LPs might push for. So some LPs might say, look, if we could invest somewhere else and get a guaranteed 7-8% annualized, then at the end of your 10-year fund, we want a minimum, the equivalent of 7-8% annualized above 100% of our money back before you distribute money. Many of the LPAs will dictate how long you have to actually invest. So you must deploy money between point A and point B. LPAs will also dictate what do you do with money that you get back. Let's say you invested in a company, the company did really well, it got acquired, suddenly you have new cash on hand. Do you return that to LPs or do you put that back into new investments? It depends. Some LPs want to get that money back, so they know that the GP has their mind in the right place. They're focused on returning money at all costs. But actually, from an economics point of view, if you were to reinvest it into companies which have already shown signs of being successful that you've backed before, you can actually double down on your winners and get a higher winning at the end of the day. That's what we call economics recycling or fund economics recycling in the investment context. So there's many different terms. I'm not going to go into it. It's 50-page documents often. But suffice to say that VCs don't have as much liberty as they like to put out in the public space, simply because that LPA is that major contract, even more important than your job contract between you and your own VC. This is your contract between you and whose money you're managing.
I think this is very important, not only for people operating in the VC space, but on the other side of the table, founders, to kind of understand how things work under the hood. So then there's less frustration and disappointment when things don't go a certain way. So staying in this LPA, what happens when a VC firm at the end of the period, the 10-year period, are unable to return the agreed upon amount of money that they were supposed to return to the LPs?
Well, unfortunately, that happens more often than you might think. VCs also operate in a world dictated by a particular business model that anybody who wants to join the VC space needs to understand, called the power law curve. Now, the way that the returns work in VC is that everybody takes a certain degree of risk because everybody is trying to find the outlier investments. Because everybody takes this certain degree of risk, everybody has a high rate of failure. But some companies have mitigating provisions which can reduce that risk or improve the likelihood of success in spite of that high rate of failure. What that actually means is that it ends up being a scenario where in most sectors, a select few companies will succeed and everybody else will be pushed out of the market. And that's what we see in VC at large as well. A small number of VCs have a potentially unlimited amount of return. And this is where you see some funds claiming that they've returned 50 times money to the investors, 100 times money to the investors, made all of their LPs millionaires or billionaires just from the return. And you have the rest of the industry that underperforms. So let's focus on what happens to the rest of industry, to the 50% that don't return the desired promise that they promised to the industry. Well, for those, there's a few consequences. Number one, the most obvious, is the reputational consequence for you. As a fund manager, one of the biggest assets that you have is your social capital. Who owns your relationship? Who do you connect to? How much do they trust you? And ultimately, like anything in financial services, trust is one of your biggest assets. That trust is very quickly lost. It can be lost by making poor investment decisions. It can be lost by not returning capital on time. And it can definitely be lost by doing both of these together. You invest in companies, the companies collapse, whether for your fault or otherwise, you are still the one who was responsible for managing that money. So even if you invested in companies and 10 out of 10 companies, all of them were actually cases of fraud, not a case of you intentionally supporting that fraud, the decision from most LPs will be that it shows something about your judgment, that you are not able to discern the likelihood of fraud in that portfolio. So that means you are not likely to be a good fund manager. What that leads to is, in essence, almost a form of exile from the industry. A founder who fails to build a business and collapses the company often will have some experience that will make them more likely to succeed the next time around. That's not necessarily the case with a VC. A VC who invests in the set of companies only gets to know if they've actually made the correct decision or bad decision on a 5-year or 10-year life cycle. Because it takes so long to actually get liquidity, a VC might be investing in their 20s and find out by the time they were 30 that the investment decisions they made when they were 20 were false. What does that mean? They might be wiser now, they might be more experienced, but no one's going to reward them for losing all that money. If anything, it might have eliminated a set of potential LPs from ever giving them money again because they are burned by that experience. So generally speaking, the very first one is this, let's say, social exile from the industry. Many people get washed out of the VC space, and one of the most common ways is firstly failing to get liquidity, and the second most common is burnout. Simply because the space is one where there's a lot of pressure, there's a lot of expectation to manifest that return. And often you're working, as I said, on a salary that's lower than you'd get in the bigger institutions because you have a higher potential upside if things go well. If things don't go well, you start to question what you were doing for the last decade of your life, investing in a strategy that might not work. So I think the very first one is that one. Now, there are consequences in particular markets that are different to the norm. So, for example, if you're in the US, you're in the UK, you're in Europe, your fund is registered in Mauritius or anywhere else among the more common jurisdictions, then the biggest consequence for you, you've lost money while the fund is liquidated. Any potential money that could be returned to LPs is returned to LPs, but that's it. There is no criminal convictions or penalties for you. In some African countries and in parts of Asia, it gets a little bit more serious. You as an individual can be held liable for those funds. Now, what happens if you do not pay a loan and you are held individually liable for those funds? They can come for your house, they can come for your personal assets, they can come for your savings. What happens if you do that, but also with government funds? Suddenly, you're actually not only in breach of a loan or a contract with the institution, but you're potentially facing a criminal penalty. So actually what we saw before in some markets, in China and in some parts of the African markets, where you are managing funds that have a legal connotation of what happens if you lose that money, well, you might be facing a criminal penalty at the end of the day. So an even bigger incentive not to lose that money, but potentially a counterproductive incentive in encouraging people to manage that money in the first case. So biggest reason is you might fall off the industry, but the secondary ones is there might be additional consequences beyond that.
You're right. We're going to get to talking about the other facet of who you are. You defined yourself in 3 words. The second one was being an educator, and I would assume that's where Dream VC comes in. So we'll talk about that in a moment. But let's stay in this lane for a bit longer. What we've seen in the VC space in Africa particularly is there's been a rise in, in the VC space, say the early 2019 and going to 2021 was this peak of investment, and then there was a downfall, and VC referred to that period as a winter season. And so then they were raising again for a long period of time. And we saw after that investment was not going as fast as it was going initially because, well, there wasn't enough capital around anyway, but also it seems like the investors themselves had learned something about the market. So I would want to get your sentiment on that particular journey of investing in Africa, let's say from that period, 2019, just before COVID, into the now. What does that space look like?
It's an interesting question because this is actually one of those points where I sometimes say that it does help to have a bird's eye picture view, whether that comes from economics or politics or maybe geography or geopolitics. If someone does have that approach to working in the VC space, it doesn't manifest in helping you day to day, but it does help you think of the venture and startup space as an interconnected system. You might think that being based in the DRC or in South Africa or Nigeria or Kenya or Egypt, you are somewhat insulated from what goes on in the rest of the world. But realistically, that's a pretty naive assumption. It's a naive assumption for sure in public markets, where a lot of public market activity is dominated by wherever the biggest pools of capital are in the world, in the US, in Asia, in Europe, and the Middle East. But it's still dominated to some extent through international flows, even in private markets. What do I mean by that? Now, let's imagine you're a family business. You like to build a new innovation or a new technology, and you decide to build that underneath your family holding. It seems like the money is yours, the revenue is yours, you're likely making money in local currency, you're employing local employees. You shouldn't care about what happens in the US. But what happens if the US goes through a financial crisis? That affects not just US institutions, but any institution which had secured their money or kept their money in the US. That sends shockwaves in terms of confidence and behavior, potentially leads to either a rise or fall of interest rates, depending on the particular effect it has on the economy, which then affects any lender from the US. Now, that lender from the US might have lent to a lender in Europe. The lender in Europe might have lent to the government locally in somewhere in an African country. That government might have then lent that money to banks, and banking institutions might have lent that money to a family holding. So the family, which in theory is, let's say, 10 different relationships away from anything that might be happening in the US, suddenly discovers that interest rates have gone up by 10% per year. And there's no explanation locally. Nothing has actually changed. The economy is still the economy. You're producing the same goods. You're consuming the same goods. But suddenly, interest rates are much higher. Suddenly, that means you might not be able to take on loan to power your business. If you're not able to take on loans, maybe your business plan fails and your new project collapses. So this type of chain of events that I've laid out is just a more structured way to think about what colloquially people on social media like to call the butterfly effect. A butterfly flaps its wings somewhere in Latin America and East Asia has a tornado. It's not a direct correlation, not a direct relationship between event A and event B, but a lot of things operate in sequence. So what is the sequence that existed prior to really 2021? Well, one, between 2015 and about 2020, globally, interest rates were falling. Now, I know that for some of our listeners, maybe based in a number of African countries, this might be a little bit of an unusual sentiment because we tend to see that interest rates only rise and rise and rise. Now, why do interest rates rise and rise and rise in many African countries? Unfortunately, it's because the countries at large import more than they export, which means there is a lot of demand for foreign currency, limited demand for local currency, which means that your local currency loses power over time relative to foreign currency. When your local currency loses power, it becomes worth less over time, which leads to inflation, which means that everything starts to cost more in local currency terms. How do you adjust for inflation? How do you keep supermarkets and keep shops from raising prices? Well, you encourage people not to spend more money, but to leave that money in banks. How do you do that? By raising the interest rates. So interest rates for cyclical reasons often will continue to rise as long as economies are net exporters or as long as there are inflationary problems. So in African markets, interest rates rise. But then if you look at large around the world, in the US and Europe and many other countries which are net exporters, which export more than they import, in those countries' contexts, often they have very strong currencies and they don't necessarily have very high inflation. Because they don't have very high inflation, banks have no incentive to give you a high interest rate. And there was this crazy event that happened where at some point in time in the late 2010s, several banking institutions in Switzerland and Austria were offering negative interest rates, which essentially means if you put your money in the bank will take some of your money. Rather than rewarding you for putting money in the banks were penalizing you for leaving money in a bank because the government was trying to do anything possible to stimulate people from being less of a hoarder and more of a spender. That's the exact opposite of what we tend to see in many other developing markets. Now, take that scenario where you have very low interest rates in banks. What does that mean for venture capitalists and the whole limited partner universe? Well, limited partners usually keep most of their money in safe assets, not in VC funds. They keep it in government bills and treasury bills and bank deposits and stocks. What do you do when these government bills are considered very safe and giving you a very low return? When you leave your money in the bank and the bank not only doesn't give you a high return, they're actually telling you we're going to take some of your money, we're going to charge you, almost like keeping it in a vault rather than rewarding you with interest. Well, you say, well, hell, I'm not going to keep my money in the bank anymore. And you can't exactly keep a billion or trillions of dollars or euros under the carpet. You have to do something with it. So in that case, they say we'll invest somewhere where there are high returns. And where are there always high returns? In any higher risk environment. Where it's the highest risk environment in financial services, venture capital, and private equity. So late 2010s and early 2020s see an unprecedented amount of allocation into the venture capital and private equity world. We see funds who in the past have never raised more than 100 million per investment vehicle, suddenly announcing we're raising 200 million, 500 million, 700 million. We see the creation of a new term in the venture capital space in the 2010s called a mega VC, a VC fund that now manages $1 billion. A concept that would seem very crazy in the 20th century, where why would a VC who is investing in tiny companies need $1 billion? Well, they need $1 billion because suddenly there are startups worth multiple billions of dollars who are raising crazy rounds and wanting to get that money still from the VCs who understand them rather than from these late stage investors. So the entire ecosystem in some way redefines itself. VCs redefine themselves as saying we can take more money, and maybe speaks a little bit to the ego in the space, maybe speaks a bit to the lack of regulation in the space, but no one limits them from saying that. Because VCs say we can take more money and institutions want to allocate more money, they allocate that money into VC strategies and into growth funds. Suddenly, VCs and growth funds have more money than they ever had. Now, every VC in the world, as long as they're a good fund manager, will have built a model. A bit like a startup builds a business plan, the VC builds a portfolio construction model. Who will I invest in? How many investments will I make per year? What is the desired ownership I will take in each investment? It's a pretty complicated, sophisticated financial modeling exercise. You're modeling out hundreds of potential scenarios and outcomes and ownership changes, dilution, and many other things. Now, take that model, and then suddenly you have 5 times more money than you had assumed you would have. For a VC, they think, well, that's great because I have more money, I can make more investments, I can ideally just do everything times 5. But in reality, just like any other financial model, you try and move one variable up by 5, something somewhere will break. And in practice across the industry, many funds now had more money than they needed, which meant they got a bit more relaxed in terms of negotiating valuations, investing in higher value companies than they should have, which means a number of funds invested just because they had the money to invest, not because they had a good pipeline of companies to invest in, and which meant that some companies who were very well performing companies ended up with ridiculously oversubscribed rounds. What that means is there was more demand to invest than the startup actually wanted. I recall seeing in the news in 2020, 2021, someone building companies to rival Starlink and launching satellites into space, having rounds that were 170 times oversubscribed. What that means in practice is imagine you wanted to raise $1 million and you have offers saying we can give you 170 million. Now, that also encourages some bad behavior from startups, where a number of startups started taking more money than they needed and then burning through that money. Because if you don't need that money for growth, you end up paying higher salaries, getting fancier offices, buying fancy cars. So we saw across the entire ecosystem, to some degree, a bad behavior from LPs, bad behavior from VCs, bad behavior from startups. And then all of that leads us through to 2020, 2021, and then we have a pandemic. A pandemic on the scale of which we haven't had since the early 20th century, where essentially conventional commerce collapses, travel collapses, the hospitality sector collapses, and many governments simply do not know how to act or how to adapt to that pandemic. I'm sure, Daniel, you might remember the chaos we all had where do not go outside, do go outside, it's okay, it's not okay, you need another vaccine, and again, and again, and again. At some point in some countries, they were averaging between 5 to 7 vaccines per person. So some people were thinking this is already like a post-dystopian world we were living in. Obviously, that broke many different industries as well. Airlines collapsed because they could not enable that level of, or low level of demand and many other things. So all of these things essentially in some ways then broke the assumptions of that period of allocating capital. A lot of the funds that got that easy money invested and almost immediately lost that easy money. Not in 5 years, not in 10 years, but in 1 or 2 or 3 years, which burned a lot of the limited partners who had invested in VC for the first time and said, we're never going to invest in VC again. So many of these limited partners pulled back, which then had the opposite, let's say, pendulum effect. Because so many of them were pulling back, some investors who hadn't had any negative experience thought, hey, well, if everybody else I know is pulling back, I should be pulling back as well, because clearly they're seeing something that I'm not seeing. So in the same way as we had a crowding in effect in 2019, 2021 into the VC space, a lot more money flowing into VCs and hence into startups, we suddenly had a crowding out effect where many LPs tried to withdraw funds, tried to bring funds back, tried to undo their investments into VC, creating a whole cyclical areas of issue. But during that chaos and the pendulum swing of LP behavior, we also saw an interesting change in consumer behavior. Because in some ways, people stayed indoors so long in many Western markets and were disconnected for so long, we saw a birth of a whole new set of digital industries. E-commerce adoption is now much higher than it ever was in the 2010s. Digital consumption, much higher. Social media use, social network use, much higher than it ever was. In many ways, some of the traditional experiences and consumption that happened in face-to-face communication actually has gone down. Consider the number of workplaces now that have a work-from-home policy. That was never a thing. That was a thing for what others would say are hippie companies or startups who work from home on a beanbag. But everyone else, suit and tie, go in the office. You love your life, you hate your life, it doesn't matter. The office doesn't care. Go in the office, do your job, go back home. Now, the world is different. And COVID in many ways changed that. Now, finally, how do I map all of that? All of this is the same as what happened in African markets, but the post-COVID effect was a little bit more positive in a number of African markets than it was in many other parts of the world. So many other parts of the world are still recovering from what is called the VC winter, these immediate years between 2021 and 2025 when funding fell. But the positive effects, the biggest positive effect, was the onset of artificial intelligence and the industrialization of artificial intelligence, which has completely taken over the world. By some estimates, more than 80% of VC funding around the world is connected directly or indirectly to some type of AI-enabled or AI-connected investments. And in the African context, we saw finally validation for the generation one of investment funds and of startups actually getting returns in that period. We saw startups being built in the 2009, 2010, 2012, 14, 16 period, finally exiting or listing or getting bigger and succeeding and surviving despite COVID. Companies like OPay and Flutterwave and Wave and MFS and InstaDeep and others rising from African markets and being bought or sold or invested in by big global investors with a lot of money. Suddenly, Africa sounded not just like the consistently high risk, high reward opportunity, but a validated high risk, high return opportunity. And because of that validation, we saw a number of investors who'd been burned in Europe, burned in the US, burned in Asia, or frustrated by all of this pendulum swings, starting to actually say, you know what, I finally feel confident enough to invest in African markets. And that kind of brings us to today, where we have a record number of individuals who can invest in African markets. We have a record number of angels relative to ever before, a record number of VC funds relative to ever before, and a number of new LPs relative to ever before. But they're operating in a different world. No longer the Wild West, a lot more expectations, a lot more paperwork, a lot more documentation required, and many more provisions enforced by these LPs who have lost money during that heyday, now saying, hey, if we will invest in high risk, high reward, we now want to see A, B, C, D in terms of disclosure, in terms of governance, in terms of risk mitigation, which is, of course, affecting a little bit of this cowboy-esque behavior in the VC, where many more VCs are now starting to behave a bit more professionally and having to put on the tie again, metaphorically speaking.
The silver lining of all this story. I like that. All right. The second facet of who you are, as you describe yourself in 3 words, is an educator. And I know that you are co-founder and co-CEO of Dream VC. So walk us into why you call yourself an educator and talk to us about what is Dream VC about.
Yeah, well, I think this is something that I always say, and this is the same experience I've had with many peers and colleagues, is that some of the best educators end up being accidental ones. Whether you look across history, whether for religious icons, social icons, individuals in the private sector who sometimes ended up educating or teaching others, sometimes it's not the individual who always planned to be a teacher who becomes a teacher, but someone who is just enabled or given the platform or the voice to teach, who ends up teaching and sometimes having that effect. And I think certainly that's been the case for me and my team at Dream VC. Everyone on my team are former venture capitalists or former venture builders. That means everyone's careers in one way or another ended up with them investing in startups, either in Africa or in other markets before. That was the mantra, that was the belief, and we still hold the belief that it's a great part of the world to be in. Everyone was either building startups and then investing in them or investing in them right away. But for years, we've always looked at African markets, looked at emerging markets, and thought about people talking about a funding gap. A gap that comes in where people say we need lots of funds to build startups and SMEs, and there's simply not enough. You look at Africa as a continent, it's probably 15, 20% of the global population, depending on which census you trust, maybe about 5 to 7% of the global GDP, again, depending on the data that you trust, but less than 1% of global VC fund flow, which means that there is a certain difference, at least between the amount of VC funding and the share of GDP, if not the amount of VC funding and the share of population. And that is completely ignoring the fact that actually African countries at large, on average, have a higher rate of entrepreneurship than any other continent around the world. So if you actually thought meritocratically of VC funding is funding the crazy builders, crazy innovators trying to change the world, if you assume that the funding flowed from whoever has money to whoever has the most ideas, Africa as a continent should be one of the leading continents in the world by the amount of VC funding. In reality, though, Africa as a continent attracts somewhere between $3 and $6 billion in VC funding a year, which seems like a lot, but compared to hundreds of billions of dollars allocated every single year to tech companies on a global stage, is a very small percentage. In fact, someone had recently done a comparison that the entire African continent counts for as much VC funding as the top one sector of VC funding in India. So just one sector of VC funding in India accounts for the same amount of annual VC funding as all of African funding combined. And it's about the same amount of VC funding that Boston, as a city, receives per year. What does that mean? That means that Boston, one city in the US, yes, it's a city with a concentration of some of the world's leading institutions. Yes, it's a city with a strong life sciences industry. Yes, it's a city that's created a lot of wealth. One city and the metropolitan area around it receives around $5 billion in VC funding a year. And 54 countries with potentially up to 1.5 billion people, with thousands of incubators, accelerators, VC funds, angel networks, and others, also receive $5 billion in VC funding a year. Now, when you take that in context, you realize just how small the investment space is relative to the startup space. So when I started investing in African markets under a decade ago, for me and for Cindy, who would become my co-founder, we realized that you could think about the funding gap from two sides. You can continue to focus on how can we enable startups to raise funding, which most governments focus on: incubation programs, startup hubs, acceleration programs, digital incubation centers, incentives to build startups. But you cannot forget about the same steps to create more investors. Because if you create 10 times more founders, but you don't create 10 times more investors, it will not be, unfortunately, the world is not fair. It will not be the case that a Nigerian founder can easily raise from the US or from the UK or from France. No matter how much money you spend on giving them a fantastic suit, a fantastic presentation, an amazing workplace, still, some people in Europe, in the US, simply do not understand, do not know how to value, do not know how to experience investing in markets they're not familiar with. That is not going to change just like this. That takes generational change. It's changing slowly but surely. More people come to Africa from outside Africa than ever before every single year, and that will change, but it's still disproportionately small. There's only a few million people that come into the African continent per year. There's more than 80 million people that come into France every year on tourism. So a lot more people are familiar with Europe and the US and different Asian markets than they are with African markets. So what do you then need to do? Well, for me and for my team, we believe that there is a solvable gap by looking on the other side of the coin. If there are going to be so many more founders, if that is naturally growing and growing through enablement, we need to also enable a generation of African-focused and emerging markets incentivized investors, which means we need to find them, we need to capacitate them, we need to give them the ability to compete with much more funded, much more connected, potentially much more experienced international peers. And we need to bring up the standard and the perception of what it means to be an African-focused investor. Now, globally speaking, you look at the 1990s, you look at the early 2000s, who is investing in African startups and SMEs? It is not actually the high net worth African families who are mostly investing in those. With the biggest investment groups, impact investors from abroad and private commercial investors from abroad. Now, the good thing about that is money flowing into the ecosystem. The bad thing about that is if those projects succeed, the returns of that flows outside of the ecosystem again. It's what I call transient capital. The money comes in, but the money also comes out. And it doesn't necessarily cycle back in again. But what happens when you have a Nigerian-based fund investing across Africa? One, that already bridges more connectedness, more understanding, more awareness of other African markets and African unity. Two, if the African fund succeeds investing in African markets, they can attract international and local investors to trust them with money and have a bigger and bigger fund and in fact more and more startups. And three, if the fund succeeds and returns a lot of money, where is that money going? It's going back to Nigeria. So it's staying within, broadly speaking, the continental economics. So on our side, we thought that it was ridiculous that when we were making pre-seed Series A investments, usually anywhere from 5 out of 10 to 10 out of 10 of the investors on a particular deal were not African, were not in an African-focused fund, nor were they in any way connected to the African diaspora. They were just opportunistic investors from abroad. Am I saying that we wanted to penalize them? No, absolutely not. But it was unacceptable to us that was a reality. And at the same time, there were tens of thousands of multimillionaires across Africa who were not investing in these businesses. There were hundreds of thousands of individuals who wanted to be founders or entrepreneurs or investors who didn't know that was an option. And there was simply no easy step for someone to say, I'm going to become a VC. In the US, in Europe, you have business schools that offer VC training programs. You have angel investment schools. You have dedicated programs funded by local, regional, and federal government that say, hey, we want to create more fund managers. But especially when we were looking to set up Dream VC is only now entering its 5th or 6th year. So take it back to mid-COVID. We realized that basically none of these initiatives existed at any scale and at any world-class level focused on an African market. So that's what Dream VC became. We started by training just 20 or so professionals on what we believed as VC practitioners would be an ideal VC hire. And what did we see? Almost all of the 20 of them moved immediately to work in the startup space in VC roles. And even some of them were so convincing as a hire that some international funds created a new role or a new strategy focused on Africa just because of that hire. At the same time, when we were considering, should this just be a one-off or a side thing, something we do to benefit the ecosystem, we spoke to many African fund managers and they were telling us a reality that just didn't make sense. Anecdotally, I lived in Lagos for a bit, it just didn't make sense to me whatsoever. African-focused funds with less funding than New York-based peers or London-based peers were going to New York or Boston or London or Paris, trying to hire someone who was requiring a much higher salary than anyone would get in a local market, flying them out, courting them, convincing them to move to an African market where that individual neither had the experience, the connection, or the exposure, then taking anywhere from 6 months to 12 months to convince them to stay, paying them an extra premium for them to work in Nigeria or in Kenya or South Africa, and essentially creating, in some sense, this environment of an expat or foreigner-dominated investment ecosystem. Now, when we spoke to fund managers, I'm not going to name exactly who we spoke to. We spoke to a majority of the space. We were like, why would you do this? This makes no sense. And for us, what we were shocked by was that they were saying, look, well, universities are not preparing the right level of talent, and individuals do not have an incentive to leave the corporate ecosystem because VC funds and PE funds cannot pay them as well as in the US or Europe. This is one of the things that people don't realize. In the US or in Europe, a VC analyst could easily earn more than $100,000. $100,000 for an analyst level, the level 1 of the VC hierarchy. Because venture capitalism in Europe and in America is not seen as a starting job. It's seen as a job you do after many years in consulting, in banking, in engineering. It's a job that's for individuals who are really mid-career through to the latter half of their career. You see people in their 30s transitioning to be a VC, and in their 40s becoming a VC director. Now, that's not the case in markets where individuals have no incentive to make that shift and move from being a petroleum engineer or a banking executive to being mid-level in a VC fund and earning 5 times less, just on the promise that you might make a lot more if the VC fund succeeds. So suffice to say, several labor problems, let's say, several observational problems, but problems that could really be solved. And that's where Dream VC was set up, initially as a targeted specialist trade school and venture capital and private equity focused institute, enabling individuals from all walks of life who had a passion that they could demonstrate, an incentive that they could demonstrate, a commitment that they could demonstrate to focusing on Africa and other emerging markets, to come to us and essentially work with us and build the experience in an applied academic context to get the necessary skills and exposure to be business angels, to be venture capitalists, to be venture builders, to run the accelerators and incubators that enable the venture capital ecosystem. So now, 5 years later, we have more than 450 alumni. Out of these alumni, more than 150 of them work in VC funds, PE funds, impact funds, family offices. Quite a number of our alumni have created their own funds. Some have even raised money by their own. Many of them have convinced international funds to open up African-focused branches. Many of them have convinced corporates to invest in Africa for the first time. So we're really seeing a direct pre- and post-Dream VC effect. We didn't initially set out to make Dream VC a full-time thing, but when we first had that very first program, the one I told you, we focused on 20 people, we had 600 applicants for 20 slots. And that's when we realized that it wasn't just our perception of a gap. There were a lot of people who wanted to be VCs who just didn't have that step. So today, Dream VC is the largest program of this kind, focused on emerging markets, venture capital education. It's the largest one in African markets as well. And we are essentially solving this capability gap, but also a social capital gap. Because as Dream VC grew, we realized that one of the biggest advantages that Europe and the US has had is time. time is a bigger advantage than anything else. It's not creativity. It's not necessarily intellectual superiority. It's time. The VC ecosystem has existed for longer. There are more success cases that people can turn to. If you are a female founder in any rural part of Europe, you can find that some other woman that you might look up to has built a business and become successful. You might not find that similarity in Uganda or in Tanzania or somewhere else where there simply has not been enough time for enough women to succeed in the corporate space or enough men to succeed in the technology industry especially. All African unicorns, all the companies that were African tech startups that are now valued at $1 billion or more are realistically became $1 billion companies between the 2010s and today. So it's only the last 15 years that have really seen that tech revival, that tech wave across African markets. So to try and expedite that period of time, we don't want people to spend another 20, 50, 40 years building those connections. We decided that Dream VC cannot just be an institute, but has to be a lifelong community. Something that many people don't know outside of Dream VC, some people that interact with us do know that, is close to 50% of our annual budgets go back into community. We host more events for VCs than almost any other VC fund that focuses on African markets, anywhere from 50 to 100 events per year, social mixers, investors mixers, to bring together investors who otherwise don't have a reason to connect with each other, so that investors can build that relationship infrastructure that enables them to compete. Because when a US investor from Chicago invests in an African market, they're coming with connections in Boston, with connections in San Francisco, with connections in Texas. But then when a new investor goes through and becomes a VC for the first time, they don't necessarily know someone in any other African market if they are based anywhere on the continent. And that's supposed to change. So one thing that we say internally is, in some ways, Dream VC is an institute. We teach, we capacitate, and we build world-class investors who then join the space in whatever way they wish. We don't enforce, but most of them choose to do so. But we also build a modern version of a yellow books. If I might be dating myself here a little bit, but a bit like a yellow books, an index of people you can contact, a real-life WhatsApp Rolodex, where you're coming in and you have 100 contacts who can help you. People you can ask for legal questions, for financial questions, for portfolio support questions, and people in all African markets. So today we have people in about 40 out of the 54 African countries, and we're slowly but surely getting close to becoming Pan-African. And that's why I say I'm an educator. So I feel like I teach directly in teaching the individuals who are getting into the space, but I also am teaching many people how to actively compete, even active professionals. And many people do not know, but we don't just train individuals who are outside the VC space. We also train individuals who already are VCs, focused on African markets, to be the best version of themselves they can be. And every year, many African funds actually come to us and send their whole teams to our institute, specifically so that they can become bigger and actually compete with the American, European, Middle Eastern, or Asian.
Wow, Mark, as I'm hearing the story of Dream VC, and of course I'm familiar with Dream VC, but hearing it from the horse's mouth, it's strong validation from the hypothesis that I have for the book that I'm writing, From Scarcity to Scale. You are the VC version of From Scarcity to Scale. Out of a place of a need of constraints, you have built something that is market creating, as the late Professor Christensen calls it in his book, the Innovator's Dilemma, the Prosperity Paradox. He talked about market creation, innovation, but he was addressing obviously the founder. You have flipped the coin, you are doing it from the VC side of things. Market creation from the VC side of things, creating out of scarcity into scale, which is really tremendous. And I think it's worth giving you your flowers, you and your team. The impact speaks for itself. We are seeing better VCs on the continent that understand the landscape, the reality, the intricacy, that understand that in Africa, distribution is actually strategy. In Africa, you need to build trust first before you can. It's not before product comes after trust. And you are building the type of VCs that look at investment with a different lens. So, well done on that. We've covered a lot of ground. The third facet, I think you've touched on it indirectly. You're welcome to touch on it as well if you want. But we've covered a lot of ground. I do want to close by asking you one final question. We've talked about a lot of things. What is one important thing that we think we haven't talked about that you would like us to talk about? Maybe you can close with that.
Yeah. I think that in some ways I can combine that with the third facet. And there's a reason why, in some sense, even though, as you can tell from my voice and from the way we act and from what we do, that we really love our job. And, in some ways, even though we are VC enablers, we also see ourselves a little bit like founders of our own, except we are not necessarily building a startup offering a product to the general public. We're trying to offer a product or productized service to the VC world or the future VC world. But beyond that, I think over the years, especially in the last 7 or 8 years, there's been a lot of discussion around Africa is not Silicon Valley. Silicon Savannah is not Silicon Valley. We cannot emulate them. We cannot emulate someone. We cannot learn from someone, which is true, absolutely, in the sense that you cannot replicate A to B. You cannot take an orange from Japan, take the Japanese orange to the UK, and assume the orange will thrive in the UK with a completely different setup. That is applicable everywhere, not just in a global north, global south, or west and east type of divide. I think all of these divides are very superficial in today's world, where realistically you can jump on a plane and travel almost anywhere, anytime, as long as you have the financial means. I think what I really strongly believe in, two things. There is the necessity to professionalize the venture capital ecosystem and to create more investors. And that's what we're doing by both acting as investors and investing individually and through our institution, but also by creating this generation of investors. But there is also a necessity to build new systems and to build new funds and to build new sources of capital. At the moment, more than 50% of all the money that flows to African startups doesn't flow from an African pocket. It flows from an international pocket. More specifically, it flows from an international taxpayer. What do I mean by that? Most people assume that when you read about investments, especially if you're not in the startup space, that the money that comes into Africa is from a wealthy fund that's sitting somewhere in New York or London or Paris or something else. Sometimes that's true. But if you take that systematic approach that I talked about at the beginning, where you think in systems, you have to trace the money, follow the money all the way through to the source. And what you find is that actually more than 50% of the investment that ends up in African startups, African funds, comes from the developmental financing institutions. The developmental financing institutions from Belgium, from France, from Switzerland, from the UK, the US, and many other jurisdictions are not just big enablers of the space, they are the dominant incumbents. And that's what most people don't quite realize, because that's a bit of a scary notion to think about. That in today's world, where there are more than 3,000 active investors or institutions that invest in African markets, about 20 of those 3,000 dominate more than 50% of the direct funding and indirect funding. You look to raise $10 million, $20 million. Who are the investors? Half of the investors who can invest that much, developmental institutions. The other half raised money from developmental institutions. You're looking to build a project where no one has built a deep tech project before, developmental institutions. I think, Daniel, you mentioned at the beginning that you now started to work in the South African innovation space as well, in the deep tech space. Well, you look into the history of South African deep tech, a big part of that is the South African government, but the other big part of that, people forget, is the US government. The US government played an enormous role through the DFC and USAID in funding many innovation programs, funds, and projects that actually enabled the South African innovation space. And for political reasons and cultural reasons, we don't always want to acknowledge that, nor do we always want to face the reality of the scale of the projects that come through from these DFIs. And I'm not here on the podcast to decry that that's a bad thing. I mean, I think that would be very hypocritical of me sitting in Europe at the moment as we have this call and saying something's wrong with the developmental institutions, especially because I believe the generation of institutions now definitely do have a better mentality and a more practical and a more reasonable mentality than the immediate post-colonial institutions in the end of the 20th century. But what I do believe is that if we assume that this is a fact, not something that we can change or influence, what we can change or influence is what the private sector does. So what do we see in Asia? What do we see in Europe? What do we see in the US? The biggest sector that really enables startups to succeed are corporates. Corporates who procure from startups, corporates who buy solutions from startups, corporates who acquire startups, and corporates who invest in startups. Most people don't know that actually among the biggest investors in the world, they are not traditional VCs. It's investors like Salesforce Ventures, the investment arm of the corporate Salesforce. Now, what people think about Salesforce, they think, what are you doing? It's a CRM company. They build data tables. That's it. But beyond building data tables, they also have billions of dollars invested into tech startups. By enabling those investments, they're actually growing their corporate business. The corporate is not investing for the sake of let's invest in tech. They're investing and enabling everyone around the world to use CRM systems, customer relationship management systems. They're investing all over the world and finding new innovations to grow their core business. You look at the Salesforce towers, where are they based? They're based in San Francisco, very close to the hub of innovation. And that's what enables Salesforce to survive while other businesses don't. In fact, zoom out, and of the 100 biggest businesses in the world, more than 80% of them have direct startup investment arms called corporate venture capital. And I believe that corporate piece, that is really the missing piece that will enable the next shift, the next $5 billion or more increase to the total funding going into African markets. So I think naturally, because of the macro and microeconomic factors, international investment will increase. Naturally, individuals will keep getting into the space through Dream VC and maybe through other initiatives. But I think the part that will really change the before and after, the part that I really want to start to see before the end of the 2020s and hopefully into the 2030s and the 2040s, is the renaissance of the African corporate. Seeing the big corporates start to acknowledge that realistically they cannot coexist in a world with startups and completely ignore the startup. They have to find a way to compete or collaborate. And one of the only ways to do that is through corporate innovation and corporate venturing, which, just as implied by the name, if you're not familiar with what corporate innovation or corporate venturing is, corporate innovation means doing something different. However old, however successful you've been as a corporate, and corporate venturing means moving from point A to point B, exploring, diversifying, experimenting, and ideally doing that through startups. So last year was the first year where I started to see that in practice. We saw corporates become the second biggest source of funding for startups after the DFI sector and the traditional VC sector. So what does that mean? That means that some corporates are starting to wake up to that reality, but this is actually a strength where most African markets have an advantage. There are big family businesses, big local corporates, big regional corporates, which have survived and thrived and built over years a defendable base. These corporates, whether through AI or through startups, now have two paths, potentially a very feasible paths, to get involved in the technology space. And I feel like as soon as they start getting involved, buying startups, investing in funds, building their own funds, there is going to be a tremendous wave of new capital that will flow, and this will encourage international corporates to follow suit. So this is actually why last 18 months or so, we set up a new part of Dream VC, a dedicated unit called EDGE for empowering disruptive growth and entrepreneurship within the corporates themselves. And we've been working with a number of African businesses in East, West, and Northern Africa already to actually get them to deploy some of the first CVCs, or corporate venture capitals, across Africa. And I'm really excited to see that hopefully scale and grow. So I would really encourage anyone listening who hasn't previously thought about VC, realize that there is a path to VC, no matter your background, no matter your financial resources. We have a way of going down that path. Maybe that's the Dream VC Institute, maybe that's just your curiosity, but there's also a path for the corporate professional. And it's no longer the case that the corporate professional has to choose between a safe salary, a secure job, or going and becoming an entrepreneur or a VC. There is now an option where they get to do both, CVC. And that's a new option. That's an option that's not been around in African markets for very long, but that has tremendous possibility. So really excited to end on that.
Mark, thank you so much. This was such a rich conversation. And yes, we do need more VCs that understand the African landscape. And I strongly encourage anybody watching or listening to consider Dream VC. We'll put the link to the website in the description below. And if you incorporate and corporate organizations thinking about how to become more innovative, thinking about how to launch a venture arm, Dream VC with the new Edge solution as well is something worth considering. Reach out to them, reach out to Mark, reach out to Cindy, or anybody on the team really. And these people are really excited to work and continue making big impact on the African continent. Mark, thank you so much. Thank you, everybody. See you next time.